G'day everyone and welcome back to the channel. Today we need to have a very serious, very honest chat about something that is quietly robbing hundreds of thousands of Australian retirees of the comfortable, stress-free retirement they actually deserve. Before we jump into the deep end, if you're new around here or haven't done so yet, make sure you hit that subscribe button right now and toggle the bell icon. That way, you'll ensure you never miss a single update on Centrelink, pensions, and older Aussie finance updates. Now, let's talk about the massive issue that's quietly draining the joy out of retirement for so many people. I want you to picture a scenario for a moment. You're sitting on the veranda of a beautiful 4-bedroom family home in Sydney, Melbourne, or maybe Brisbane. The property market has been incredibly kind to you over the last 30 or 40 years. Your family home, the place where you raised your kids, painted the fences, and mowed the lawn every weekend, is now worth a cool 1.5, 1.8, or maybe even upwards of $2 million. On paper, you are a literal millionaire. You've achieved the great Australian dream. But then Friday rolls around, you walk down to the local Woolies or Coles, you look at the price of a basket of basic groceries and your stomach drops. You find yourself putting back the premium cut of meat, opting for the home brand instead, and worrying about whether you can afford to turn the heater on this winter because the electricity bill just skyrocketed. You're relying almost entirely on a part or full Centrelink Age Pension, and every single fortnight feels like a tightrope walk. How on earth did we get here? How can someone be a millionaire on paper but completely cash poor in reality? Well, in the financial world, this is what we call the dead equity trap, and it is one of the biggest hidden crises facing Australian seniors today. Your home is essentially killing your age pension, not because Centrelink counts the value of your home directly. We all know the primary residence is exempt from the assets test, but because that home is locking up hundreds of thousands of dollars of dead capital that could be generating an income for you, while keeping you trapped in a cycle of asset-rich, cash-poor living. In this deep dive video, we're going to unpack exactly how this trap works, why the current Centrelink rules make it so hard to break free, and most importantly, the 3 legal, practical strategies you can use right now to unlock that dead equity, boost your cash flow, and potentially even maximize your payments from Services Australia. If you want to protect your retirement and stop being a paper millionaire who worries about the grocery bill, stick around. Make sure you're subscribed with notifications on, and let's get stuck into the numbers. All right, let's start with the basics so we can understand why this paradox exists under the Australian system. Under current Australian law, your principal place of residence, the home you own and live in, is completely exempt from the Centrelink Assets Test. It doesn't matter if your home is a modest unit in Adelaide worth $400,000 or a sprawling estate in Toorak or Mosman worth $5 million. As long as you live in it, Centrelink looks at that house and says, yep, value equals 0 for our asset calculations. Now, at first glance, this sounds like an incredibly generous rule. The government is protecting your home, ensuring you won't be forced to sell it just to qualify for the age pension. But this very exemption creates a massive psychological and financial trap. Because the home is exempt, generations of Australians have been conditioned to put every single spare dollar they have into paying off their mortgage or upgrading their property. The mindset is, put money into the house, it's safe from Centrelink. But here is the catch. You cannot eat bricks and mortar. You cannot use the dirt your house sits on to pay for a dental bill, a trip to see your grandkids in Perth, or your skyrocketing private health insurance premiums. Let's look at a quick comparison to show you how Centrelink's system actually creates an uneven playing field. Take couple A, the traditional homeowners. They own a $2 million home. Because it's exempt, they easily pass the asset test because their other assets, their superannuation, their car, their furniture, only total $250,000. So Centrelink grants them a very healthy pension payment, but because their actual liquid cash and super are so low, their overall disposable income is tiny. They are entirely at the mercy of the government's fortnightly pension rate. If inflation goes up 6%, but the pension only indexes by 3%, they feel the squeeze immediately. Now look at couple B, the renters or downsizers. They have no family home value, but their assessable assets in super and cash total $850,000. This might mean their Centrelink pension is heavily reduced or tapered off due to the asset test limits. However, because they have hundreds of thousands of dollars sitting in high-yield savings accounts, managed funds, or superannuation, they can draw down on that money whenever they want. Their fortnightly cash flow is high. Couple A is living in a multi-million-dollar fortress but eating baked beans. Couple B is living comfortably, enjoying their lifestyle because their wealth is liquid. When your wealth is tied up in your home, it is called dead equity. It is equity that is doing absolutely nothing for your daily quality of life. It's sitting there, waiting for your beneficiaries to inherit it. Now, don't get me wrong. Wanting to leave an inheritance for your kids is an incredibly noble thing. But should you live in relative poverty for 25 years of retirement just so your kids can inherit a $2 million house when they are already in their 50s and established? That's the question more and more Aussie seniors are asking themselves. To make matters worse, the massive boom in Australian property prices over the last few years has accelerated this trap. Your house has likely doubled or tripled in value over the last decade, but your wallet hasn't. Let's talk about how the Centrelink asset limits work for homeowners. Because even though your home is exempt, the moment you try to touch that equity or the moment you look at your other assets, the Centrelink thresholds can catch you completely off guard. If you are a homeowner couple, as of current rates, the asset limit to receive the full age pension is sitting around those standard indexed thresholds. The moment your assessable assets go over that limit, your pension reduces by $3.00 per fortnight for every $1,000 of excess assets. This is known as the taper rate. Let's break down how this taper rate penalizes people who try to shift their money around and why people become terrified of doing anything with their home. Imagine you say, right, I've had enough of being cash poor. I'm going to sell my big house for $1.8 million, buy a lovely little townhouse for $800,000, and put the remaining $1 million into the bank so I can enjoy my life. The moment you do that, that $1 million cash goes from being exempt equity inside your home to assessable assets sitting in your bank account. Let's do the math on Centrelink's taper rate. If you have an extra $1 million in assessable assets, your pension drops by $3.00 for every $1,000. That means your pension is reduced by a massive $3,000 per fortnight. Because that exceeds the maximum couple pension rate, your Centrelink Age Pension completely vanishes. You get wiped out of the system. And this is exactly why seniors are absolutely terrified to sell their homes. They look at the system and say, well, if I sell my home and downsize, Centrelink is going to cut me off completely. I'll lose my pensioner concession card, I'll lose my cheap medicines, I'll lose my council rate discounts, and I'll have to live off my own savings until it runs out. So what do they do instead? They choose to stay in the giant empty 4-bedroom house. They don't sell. They keep their asset completely hidden within the Centrelink exemption fence, and they continue to struggle through retirement on a minimal cash flow. It is a self-inflicted trap driven by a completely understandable fear of the Centrelink system. But here's the good news. The Australian government actually realised that this was happening. They realised that seniors were hoarding massive family homes, which was also causing a housing shortage for young families. So they introduced specific rules to help you break free from the debt equity trap without getting completely destroyed by the asset test. The first major tool in your arsenal to fight the debt equity trap is the government's official downsizing rule. And there have been some fantastic, highly beneficial updates to this policy recently that you absolutely need to know about. If you decide to sell your principal home to downsize, the biggest fear used to be that the cash from the sale would immediately stop your pension while you were looking for a new house. But under the current rules, the government provides you with a 24-month asset test exemption on the proceeds of your sale that you intend to use to buy or build a new home. Let's break down exactly how this works with a realistic example, because this is where you can legally shield your money. Let's say you sell your big family home in Sydney for $2 million. You find a beautiful, low-maintenance villa on the Central Coast for $1.2 million, but it's still under construction, or you haven't finalised the contract yet. You have $800,000 in cold, hard cash sitting in your bank account from the gap between the sale and the purchase. Under the 24-month shield rule, Centrelink will completely exclude that $800,000 from your assets test for up to 2 years, provided that money is earmarked for your next principal home. This gives you a massive breathing space. You don't lose your pension overnight. You have time to structure your affairs properly. But it gets even better. What happens to the money after you buy the cheaper home and you have a leftover surplus? Let's say you finish buying the villa for $1.2 million and you have a permanent surplus of $800,000 cash left over. If you just leave that in a standard bank account, yes, it will eventually count against your asset test once the new home is settled, and it will be subject to Centrelink's deeming rates. However, you can take advantage of the Downsizer Superannuation Contribution Scheme. If you are eligible, you and your partner can each contribute up to $300,000 directly into your superannuation accounts from the proceeds of selling your home. That's a total of $600,000 per couple. that you can dump straight into the highly tax-effective superannuation environment with no upper age limit, provided you have owned the home for 10 or more years. Now you might ask, hold on, if I put it into super, isn't it still an assessable asset for Centrelink once I'm over age pension age? Yes, it is. It will be assessed under the asset test and deemed under the income test. But here is the monumental difference to your lifestyle. Instead of that money sitting dead in the walls of a giant house, that $600,000 inside an account-based pension fund can now generate a steady, reliable, tax-free income stream for you of, say, 5% or 6% per year. That is an extra $30,000 to $36,000 a year of cash flowing directly into your pocket. Even if your Centrelink Age pension drops slightly due to having more assessable assets, your total combined income, your reduced pension plus your new super income stream, is almost always significantly higher than what you were getting before. You have successfully converted dead capital into active, spendable cash flow. You can finally afford the holidays, the lifestyle upgrades, and the peace of mind you've been missing. Now, I know what some of you are thinking. Look, that downsizer strategy sounds great if you want to move, but I love my house. My neighbors are here. My local doctor is down the road, and my garden is my pride and joy. I do not want to move. Is there a way for me to get cash out of my house without selling it? The answer is a resounding yes. And you don't have to go to a predatory private bank to get a high-interest reverse mortgage. You can use a government-backed program called the Home Equity Access Scheme, or HEAS for short. Some of you might remember this by its old name, the Pension Loan Scheme, but it was rebranded and made significantly more flexible. The Home Equity Access Scheme is essentially a voluntary government-backed reverse mortgage designed specifically for older Australians who are asset-rich but cash-poor. It allows you to use the equity tied up in your Australian real estate as collateral to receive a regular tax-free fortnightly loan payment from the government to boost your income. With the HEAS, you can choose to receive a fortnightly payout that bumps up your total income to a maximum of 150% of the maximum fortnightly age pension rate. So, if you are currently getting a full age pension, you can use HEAS to get an extra 50% on top of that every single fortnight, paid directly by Centrelink. If you are currently getting a part pension, or even if you get zero pension because your other assets are too high, but you still own your home, you can use this scheme to generate a massive stream of tax-free cash up to that 150% threshold. And the absolute best part about the Home Equity Access Scheme, it does not affect your current Centrelink Age pension payments. Because the money you receive is technically structured as a loan, Centrelink does not count it as income under the income test, and they don't count it as an asset. Now, let's be completely transparent here. This is a peer-to-peer style conversation, and I'm not going to sugarcoat things. This is a loan, which means the government does charge interest. The interest rate accumulates over time against the value of your property. However, the interest rates on the HEAS are typically significantly lower than commercial reverse mortgages offered by the big banks, and the interest compounds safely in the background. Furthermore, the government has put strict protections in place. They guarantee that you can never owe more than the value of your property, and you can choose to repay the loan at any time, either out of your pocket or, more commonly, the loan simply gets cleared automatically out of the proceeds of your estate when the home is eventually sold down the track. Let's look at a case study of how this changes a real Aussie couple's life. Meet John and Margaret. They own a home in Melbourne worth $1.4 million. They get a combined part pension, but they are constantly stressed about money. They want to renovate their leaking roof, and they want an extra $400 a fortnight just to live comfortably without stress. They sign up for the HEAS. Centrelink begins depositing that extra money into their account every fortnight. The roof gets fixed, they start enjoying their weekly dinners out with friends again, and their stress completely evaporates. Yes, a small debt is slowly building up against their $1.4 million home, but even after 10 years, that debt only represents a tiny fraction of the home's total value. John and Margaret got to stay in the home they love while effectively forcing their debt equity to pay for their lifestyle. That is how you beat the trap while staying put. The third and final strategy to unlock debt equity is an incredibly popular one for families who want to stick together, and it relies on a very specific, highly lucrative loophole in Centrelink's handbook known as the granny flat interest rules. Now, don't let the name fool you. A granny flat arrangement under Centrelink rules doesn't actually mean you have to build a literal timber cabin in your kid's backyard, although you certainly can. In the eyes of Services Australia, A granny flat interest is a legal arrangement where you transfer the ownership of your current home, or you contribute a significant amount of cash from the sale of your home to your children in exchange for a lifetime right to live in a specific property. Let's see how this works to completely legally optimize your pension status. Imagine you sell your massive family home for $1.5 million. You keep $500,000 for your own retirement savings, and you give the remaining $1 million to your son or daughter to help them buy a larger family home with a self-contained wing or a beautiful granny flat built underneath for you. Normally, if you give $1 million to your children, Centrelink would scream, "Aha, that is a deprived asset. You've violated the gifting rules." As you probably know, Centrelink only allows you to gift a maximum of $10,000 per financial year, or $30,000 over a rolling 5-year period. Anything over that is assessed as a deprived asset for 5 years, and they deem you on money you don't even have anymore. But under the official granny flat interest rules, if that money is transferred as a formal legal contribution to secure your lifetime accommodation in their property, Centrelink fully exempts that entire transfer from the gifting rules. The $1 million is no longer counted as your asset. It belongs to the home property of your child. Meanwhile, your personal asset pool has dropped significantly down to that $500,000 mark. Because your assessable assets are now much lower, your Centrelink Age Pension can instantly shoot up from a tiny part pension right up to the maximum full age pension rate. You have achieved 3 massive wins simultaneously. 1. You've helped your kids get into the property market or pay off their mortgage. 2. You've secured a safe, comfortable place to live with your family close by as you age. 3. You've legally minimized your asset pool to unlock the maximum possible ongoing payment from Centrelink. But a word of absolute warning here. A granny flat arrangement must be documented properly with a legal agreement. If family dynamics change down the track, or if your health changes and you need to move into aged care within 5 years of setting up the arrangement, Centrelink will review the setup, and it can cause massive complications if it wasn't structured correctly from day one. Always get a formal solicitor to draft a granny flat agreement before moving a single dollar. As we wrap up today's deep dive, let's summarize the core lesson here. Being asset rich and cash poor is a choice driven by the system, but you do not have to accept it. The debt equity trap is real, but you have clear legal paths out of it. You can downsize and utilize the 24-month asset shield alongside the downsizer super contribution to turn bricks into a tax-free income stream. You can use the Home Equity Access Scheme, HEAS, to borrow safely against your home from the government, boosting your fortnightly cash flow without affecting your current pension. Or you can explore a granny flat interest to pass wealth down to the next generation early while maximizing your own Centrelink eligibility. But before you take action on any of these strategies, remember that the Centrelink rules are incredibly complex and interlocking. One wrong move on a property settlement date or a gifting declaration can accidentally trigger a penalty that takes months to fix. I highly recommend booking an appointment with Centrelink's free financial information service, FIS officers. They are specialized experts within Services Australia who won't give you personal financial advice, but they will run your exact numbers through their calculators to show you precisely how a sale, a loan, or a contribution will impact your fortnightly pension check. Now, I want to hear from you. Are you currently sitting in a home that has skyrocketed in value, but you feel the pinch every time you go to the checkout? Are you considering downsizing, or have you ever looked into the Home Equity Access Scheme? Let me know your thoughts, your experiences, and your questions in the comments section below. I read and reply to as many comments as I can, and your feedback helps me design the next deep dive guides for this channel. If you found this video helpful, please give it a massive thumbs up. It really helps the YouTube algorithm push this vital information to other Aussie seniors who need to see it. Don't forget to hit subscribe and turn on that notification bell so you never miss an update on your pension, your taxes, and your retirement wealth. Thanks for watching, look after yourselves, and I'll see you in the very next video.